Your money is not safe in the banks. My name's Daniel. Last year we got 1.3 million out of banks. Here's why. First, even if you are keeping money below the FDIC insurance limit, you still have to deal with three major problems. Those are inflation, a low yield or a low return, and that low return is still going to be taxed. So if you had just $100,000 sitting in a bank as an emergency fund, let's say you were getting 1%, which is higher than most Americans, by the way, that means you are gaining $1,000 a year. You still have to pay taxes. Let's be generous and just say that that is going to be 20%. You have $800 you made that year that the bank credited you. That means on the money that you were keeping in the bank just sitting there, you gained a 0.8% return. However, inflation over the last 100 years has been around 3%. So if this is the case, your 100,000 went from 100,000 to 100,800. You made an $800 gain. However, if you wanted that money to hold its purchasing power, you would have had to have that money turn in to 103,000. That means even though it looks like you just gained $800, you actually lost $2,200 in purchasing power. If you divide the two of these into each other, you'll see you lost about 2.1% of the purchasing power of that money. To make this point even clearer, if you did this over a 10-year horizon, you kept this money just sitting in the bank, earning 1%, 0.8% after taxes, you would have earned, this is after 10 years, approximately $8,300. And if this money was going to keep up with inflation, it should have grown about $34,391. So you lost, again, if you divide this number into this number, you lost 19.42% of your purchasing power just by keeping that $100,000 in a bank over a 10-year period. If you extended that horizon to a 30-year period, you will lose over 47% of the purchasing power just by making that gain every single year. It looks like you're making a 0.8% gain. You're making money, you can go spend that, but ask your parents how expensive things were when they were growing up. Inflation exists, things get more expensive, and you would have lost over 47% of the purchasing power of that money. Now, second here, even when you are keeping money in the banks, we want to talk about the risk of the banks to fail, especially if it's above the FDIC insurance. Even if it's not, I'm not sure this is a process anyone wants to go through, waiting to receive money from the bank. But first, let's just look at the history. In the Great Depression, the 1930s, how many banks went under? Over 9,000. They had over $7 billion. If you inflate that to what it was today, that's over $112 billion in assets that would have been gone in the blink of an eye if you had money in the bank. This is also before FDIC insurance, so all of these people would have lost their money. From 2008 to 2015, after the housing crisis, another 500 plus banks went under. Recently, in 2023, 5 banks went under. In 2024, 2 banks went under, and already in 2025, 1 bank has gone under. Now again, if you have less than the FDIC limit, you're still going to receive this money back. But instead of just following the herd and keeping money in banks, let's instead just look at what the big banks themselves are doing with their liquid cash and follow. We have to understand that the reason that banks are able to function how they do is because they have our money, so we put money in the bank. The bank is then going to take that money, they are going to invest it in things like real estate, in things like government bonds, bills, notes, and loans. For example, we might not have as much access to those. And then if we look at where they are keeping their liquid money, this is generally in what's called bank-owned life insurance. Corporations also do this with corporate-owned life insurance, but you don't have to be a bank or a corporation to do this. A lot of big entrepreneurs, for example, Walt Disney, J.C. Penney, Ray Kroc, the founder of McDonald's, Hillary Clinton, a lot of politicians. We could even speculate that people like Donald Trump are doing things like this, but they all are keeping their money in a form of cash-valued life insurance. Well, all of these people could just be putting money in banks, but they don't do this. Why is that? That's because when these banks are investing, they are earning a return. Let's say that it is 5%. They then are able to use that gain to credit you your 0.8%. So the reason that you're able to make this gain is because they're taking your money, they're going out, they're making a rate of return, therefore they can credit you much less. So they are earning more than 4% in this specific example, and they're doing that by taking your money and putting it in places that you could do yourself and still keep this money liquid, accessible, make sure it's completely tax-free. And the best part is the banks are doing it themselves. To name a couple of them, Bank of America currently has a little over $24 billion in cash value life insurance. Wells Fargo currently has a little over $19 billion. As of September of 2024, there was over $205 billion in cash value life insurance just amongst major banks. So let's explain a little more why this works and why people will use this as an alternative to banks. So first we have the tax codes, the nature of cash value life insurance. The first thing is when the insured dies, if any of you have ever had a loved one that has passed away and had a life insurance policy, what is the nature of that money that gets passed on to the beneficiaries? That money is transferring income tax-free. And that is because it's life insurance. People are buying this to cover the cost of their funerals, to replace their income, to cover estate tax, to take care of their families, all of these sorts of things. The government understands this. They don't want this money to be taxable when someone passes away. That is because of tax code 101A. The next thing is when there is cash value inside of an insurance policy, because sometimes people will overpay for their insurance, pay more upfront, they'll create cash value that'll grow and cover the cost of insurance later. Because this is the case, again, the government doesn't want this money to be taxed because it's bought by people to protect their families. This money is growing, not tax-free, but tax-deferred. This is from tax code 7702. However, what most of these banks notice, what most of these big entrepreneurs notice, they are able to access this money, even though it's growing, tax-deferred, completely income tax-free through tax code 72E. There's a couple different ways you can do this. First, they can withdraw everything that they put in completely income tax-free. That's because you have to fund the policy with post-tax dollars. You can also withdraw above that, but since the money is growing tax-deferred, what's going to happen? That money is going to be fully taxable. This is not how banks, how corporations, how these big entrepreneurs are accessing their money. Instead, what they are doing is taking tax-free policy loans. First, there's zero wash or fixed loans, which is basically you loan the money out at a fixed rate, say it's 2%. However, they're going to credit you an equal and opposite rate of return. So if you have to pay 2% for a loan, the insurance company is also going to credit you 2%, kind of like covering the cost of that loan. Hence, it's a zero wash and it's still tax-free. The second is variable loans. Again, these are going to be completely tax-free. It's a variable rate that you're loaning at. However, you do have the opportunity to earn a higher rate of return than you're actually loaning at. But that's how you access the money, completely tax-free. That's what the big entrepreneurs and banks are doing. The most important thing, however, is even though all of these tax codes exist and are to be taken advantage of, the policy that someone buys has to be structured the correct way. Not every permanent life insurance policy is created equal. Different products, different policies, different companies are made to serve different purposes. To follow what the banks and entrepreneurs are doing, the first and most important thing is that when you put money into the policy, the most amount of money allowed by the IRS has to go towards the cash value. The least amount, as required by the IRS, needs to go towards the death benefit, the cost of insurance. Why is that? Well, because these entrepreneurs and banks aren't necessarily buying this insurance for the insurance. They're more so concerned with the cash value and being able to use this while they're living. So they say, I want the least amount of insurance you guys will allow me to have and have all of the rest of that money be considered cash value so I can have that grow tax deferred, access it tax-free, and transfer tax-free upon my death. Once then the policy is then structured correctly like this, which you do have to have an agent who knows what they're doing. Otherwise, if it's not structured correctly, the agent not only is going to get paid more, but the money is not going to grow and you're not going to be able to use this how we're describing in this video. But if you have that squared away, then we go back to these three problems of inflation, a low yield, and the money still being taxed. And look at the big difference here. So first, let's say you have it in a cash value life insurance policy and you're gaining 4%. Well, if that's the case, you just gained $4,000. So again, we're keeping this real conservative here. Well, that means you still have to pay taxes on that money, right? Well, no, you actually do not have to pay any taxes on that money. It's cash value life insurance. It grows tax deferred and you can access it tax-free. So in this case, at the end of the day, you made a 4% gain that's completely tax-free. Inflation went up by 3%. In this case, you've beat inflation, you don't have a low yield, and you don't have to pay any taxes because of that. So over the course of 1 year, are you going to lose 2.1% of your purchasing power? Of course you're not. You're going to gain about 1% of your purchasing power. If you continue that over 10 years, you're going to gain a little less than 10% of your purchasing power. If you do this over 30 years, you're going to continue to gain a significant amount of purchasing power. It's all tax-free. It's not low yielding. You've cut out the middleman. You aren't relying on the banks to give you a small rate of return when you could take your money, do exactly what the banks are doing, do exactly what the big entrepreneurs are doing, earn a higher rate of return, and keep it safer and tax-free. I encourage you, if you'd like to learn much more about these strategies, continue to educate yourself, subscribe. I release videos 3 times a week. I look forward to seeing you in a future video. Bye-bye.